Check, check. Cool. All right, so Selkis and Charles took some of our time. So while the panelists are coming out, I'll introduce them, and then we'll get into, hopefully, a pretty heated debate. My name's John. This is Barney. He's founder of Vega Protocol. Little alpha launching in October, hopefully November. Vega is going to be a layer 1 for derivatives. So it's going to have primitives built in to allow you to build new derivative
I like seeing guys up
use
there.
cases. Brandon is COO at Euler, a lending protocol. Hart is at UMA. They do optimistic oracles. And last, we have Simon of Voltz. Simon thinks Voltz is the most recent 0-to-1 innovation in DeFi. People complain about no more primitives, and he says, look at us. So we had a really good conversation at lunch where I said DeFi kind of sucks, and everyone got really mad at me. But I'm going to defend myself, and they're going to hopefully rip the argument apart. So the name of the panel is about using derivatives to catch up with TradFi. And it's a slightly silly premise, because obviously the size of the crypto market is much smaller than like the real economy. So what I do want to point out is that DeFi's first product market fit is speculation and trading. And that's dominated by derivatives. Not only that, it has what we all agree is the best financial innovation of the last 10 years, which is perps. So when we put derivatives in crypto, in DeFi, we do it better, and we do it. So the question I have for you guys to start, in DeFi, we don't do much fi. Brandon had a great saying that finance is the oil that greases the wheels of real commerce. So how do we get financing into crypto, and what role will derivatives play in bringing it there? All at once?
Who's going first here? All right. How do we get finance into crypto? So one of the things we talked about at lunch is like, what are we financing? And I got 2 points on this, something we didn't talk about and something that I think DeFi is winning at, where we do have a truly global financial system. And I think it is worth reminding, and maybe this has been overblown now, but if you're in TradFi and you're trading on your Robinhood app, like I can't do that in Canada. I can't, it's not global innovations. We're not able to tap a global market. And so DeFi does preclude a new financial system that is global by default. That's cool and exciting. How do we finance things? Well, what are we financing? We're financing the development of smart contract protocols and systems, like on-chain protocols, DAOs. That's all pretty new shit, so we're kind of financing stuff from day one. Let's get other panelists in here, too.
I tend to agree with that. I feel like there needs to be a real-world asset use case for DeFi. It's yet to emerge. I think we're sort of seeing a bit of the early days of that. But it's DeFi, if you use the same parable that you said a moment ago, that finance is the oil that greases the wheels, DeFi needs to grease something. And so what are those wheels? Real-world assets, I think, are one thing. Not to say that you're going to instantly have real estate in Wyoming that's on-chain, but there's something between that and where we are right now, which is super early days.
Yeah, I think I'll pick up on something Hart said, and I mentioned that DeFi is kind of financing itself, and that's actually a sort of super interesting thing, and it's probably both a cause of a lot of innovation and a lot of the way that DeFi and crypto has grown so quickly, but it also can be a cause of some of the less good stuff that we see, in that previously innovations are not self-financing on day one. Like, so the internet was a bunch of people doing research, being computer nerds and whatever, and interacting, but to get financed, it required the financial system to come in and help develop that. Whereas crypto being about money and finance itself, and DeFi being about finance, has been self-financing. And that's fantastic, because it means that we can finance innovations sort of within our ecosystem, but it also means that people who want to do self-financing things that are not very innovative, or may even be outright scams, kind of have a way to get in and maybe distract from some of the longer-term interesting use cases.
Yeah, and maybe just to add to that, I think one of the things we were talking about at lunch is just like there's really two sides in terms of the way in which DeFi can continue to grow. There's one which is like Web3 only economy, and figuring out how we can kind of grow that ecosystem by kind of using DeFi to finance that and encourage growth. And then alongside that, we've got the so-called real economy. And I think one of the things that I'm really excited to see happen over the coming years actually is obviously both of these sides kind of continuing to grow. But in particular, I think there's a massive opportunity to start plugging DeFi rails into the so-called kind of like real economy.
Oh, go ahead.
Well, no, this is like, we'll make this all spicy and like try to debate things, but I've played around for a while with the thesis of like DeFi rails and TradFi, and there's lots of reasons why I think that is a good thing and can make sense. Like fundamentally, you can have less middlemen, more efficiency. Just think the general arc of like the technology is better, and so better technology leads to better products, and it should win, right? But I also think that there's a lot of evidence that TradFi, like they're based on legal recourse. In DeFi, fundamentally, there's no one to sue. There's like a round peg, square hole problem here of fitting these two things together that I think is big, like it's a big problem. And so part of me is like, okay, well, let's go back to the early stages of the internet argument. Early stages of the internet, it wasn't really Time Magazine using the internet to put Time Magazine out there. That was like boring. The early stages of the internet, it was weird people on the internet talking about the internet, doing internet things. And that's kind of where we are with DeFi. We're a bunch of weird finance people doing weird finance shit on DeFi in a circular, self-referential way that invents fun and interesting things that are eventually such big innovations that the traditional companies are like forced to use them.
Yeah, yeah.
That's fine.
I like that. I think what we kind of did in DeFi to start was, to your point, is we financed DeFi, which is quite circular in trading. So then there's two options. We can either finance where there is real commerce in crypto, which is an interesting question that we can think about. Like, is there crypto native commerce? Something that's not actually building real world things, but building things digitally. What do you guys think?
I think there definitely is, and I think there's sort of digitally native commerce and crypto native commerce, and digitally native commerce could just be things that exist virtually or online, but do not necessarily have to be in crypto, but crypto provides more efficiency or more access. And in some ways, DeFi actually, money is becoming increasingly digital, and so DeFi and finance are kind of meeting each other at this kind of digital intersection. And kind of to the earlier points about sort of the global reach, if you have a long tail of markets that might not be easy to fund or easy to find liquidity or easy to build in the current traditional finance world, with sort of geographic separation and with the difficulty of becoming a supplier of liquidity, for instance, then the DeFi model can suddenly open up a whole global pool of capital and pool of users to that sort of digital commerce. But then taking it further, some of those activities are entirely enabled by potentially the crypto ecosystem. And so things like NFTs are the beginnings of looking at some of that new wave of stuff, and things, the metaverse, which has about 1 billion definitions at this point, but at least some versions of that are open crypto-enabled protocols, which really you wouldn't be able to create some of those visions without DeFi and without the crypto infrastructure around it.
And Brandon, I think you had some thoughts on ways we can find value using crypto-native tools.
Yeah, I was going to say there's something like crypto-native adjacent, which is sort of Web 2, the creator economy. I think there's a lot of promise for the creator economy to go on-chain. So right now you have platform companies like YouTube, music studios, et cetera, that sort of stand between the creator and profits, or earnings, royalties, however you want to say it, their audience even. And if some of these assets could be taken on-chain, it opens up an entire new world. And then the financialization via DeFi, I think, is quite promising and very, very compelling. So it's not crypto native quite yet, but it has, I think, it's so adjacent that it easily could be.
Slightly switching gears, Simon, you had a theory on changing the direction of capital flows from traditional into crypto the other way around. Can you tell us a bit about it?
Yeah, so one thing that I think I kind of still doing work on this in my own mind, but one thing that I think we're starting to see very clearly is that DeFi rates are anti-correlated with rates set by the Fed, set by the Bank of England, set by ECB, et cetera, which kind of makes sense because crypto is considered like a risk-on kind of environment. So it's basically your risk-free rate with the US Treasuries kind of goes up, right? You'd expect capital to start kind of come down in that side. But what's interesting is as the yield goes down, the borrowing cost goes down. So what we've actually seen over the past kind of like 2 years is there's been a lot of capital coming into the ecosystem searching for higher yield because there's been higher yield in DeFi. And like maybe that's not going to continue, right, as rates set by the Fed go up. But actually what is a positive is that borrowing costs are coming down. So instead of capital coming from outside the ecosystem into DeFi to search for yield, actually one thing which I think might be really interesting and start to play out for the next 2 years is that actually reverses and people are coming into DeFi to borrow at a lower rate than they'd get in traditional finance.
Yeah, it's super interesting. I mean, certainly like the source of yield in DeFi is just leverage for trading typically. So when you shut that down, the yields fall. And now you have this interesting, I think my question is, do you think it's because of just leverage falling, or do you think one of the benefits of DeFi is that you have a much bigger capital pool that folks in Egypt, Asia, US, anywhere can commit capital to the pool. And this drives supply up and rates down. And so now when you have an artificial increase in rate, and I shouldn't say artificial, but it's a bunch of dopes in Washington, D.C. saying we should have higher rates. And they're saying we should have higher rates, but the supply of capital is still extremely abundant. And we know that because rates are so low in crypto. So does this become a new way to kind of set the floor of financing? Like this is where liquidity, we saw it on the way up, this is where liquidity found its way, and now this is where liquidity continues to sit. Do you guys think like people are going to use crypto as their source of financing?
I mean, I think it's really tied to the macro market, right? So it's basically like if crypto's growing macro-wise, a lot of people want to borrow dollars within crypto to buy more crypto, right? And I still think that so much of the rates market, it's like weirdly just tied to the macro trends in crypto prices right now. And that's fine. Like, I don't think there's anything wrong with that. And then we have products and services like lending markets and interest rate swaps that like let smart people capitalize on that. And that's a good thing.
All right. Do you think a big part of the reason why people don't use crypto as a financing source is because of we don't have the infrastructure surrounding it, like an interest rate swap to lock in fixed rate or like risk on a lending platform? Or do you think it's just, I don't know, lack of appetite?
I'd say like a big reason people don't use crypto for financing is that financing is often bespoke, right? So a lot of the time if you're trying to finance a project or a company, the deals you do, whether it's a loan, whether it's IPO, whether it's bond issuance, are highly related to the specific company. And there's only one way we've worked out how to do that in crypto yet, which is basically selling tokens, which is pretty similar to selling another type of asset, where you're kind of like, the entity that's doing the financing is kind of like going out trying to raise money. Whereas the use case of financing in traditional finance a lot of the time is like loans or other mechanisms which are more of a product. And so the problem we have in crypto is that you have a wallet address, you don't have like a way to assess risk. So you look at financing of a loan and someone's going to look at your business, they're going to look at who you are, and they're going to work out the rate for that. You look at what we can do in crypto and it's kind of like, hey, if you've got this much collateral, you can borrow this much. And that turns out in most cases not to be a particularly efficient way of financing things. So I think a lot of the use cases for financing is like, well, if I want to go issue a token, which probably means I'm a crypto native project, we sort of got that worked out after a few years of varying changes. But for non-token issuance types of financing, we're actually only really useful where you need to stay within the crypto ecosystem. So if I've got ETH, which I'm definitely holding, and I can use them as collateral to borrow something and go mess around and get yield, that's cool. It's circular, it's cool, but I'm going to hold these ETH anyway, so like putting them up as collateral to try and make yield makes sense. But if I'm actually trying to finance some other enterprise via a loan or something else, that infrastructure doesn't really exist in crypto.
What's missing?
Well, I mean, for that example, the ability to actually evaluate that risk. I mean, sometimes, as Hart says, sometimes it actually goes back to, the specifics of knowing who someone are, having the recourse of the rule of law and things like that, where actually the ability to take someone to court because they owe you money is important, perhaps, for good price financing. So one way to look at it might be, until you recreate more of traditional finance, you might find that those financial products are the most difficult to create in crypto, whereas financial products that draw on a global pool of liquidity or offer a product to everyone or allow for, the big one for me is permissionless innovation. So if I look at how quickly you can create a website and sell something online, Shopify makes it easy. If I look at how quickly you can create a new market or a new type of derivative or a new financial product, right now outside crypto, it's incredibly hard. But with protocols on crypto like Vega and like others, you have the ability to use a bunch of primitives that are already there, develop something in your bedroom, in your dorm room, wherever, put it live, potentially raise money and collect liquidity globally, and have it available to the whole global marketplace. Now, deployed properly, that has a lot of use cases outside crypto.
Do you guys think one of the most important primitives we could build would be like a regulatory buy-in for users? So you can say, I'm willing to supply collateral that abides by this regulation's rules, or for this regulation's rules, or no rules?
Yeah, I mean, we've definitely been thinking that way with Vega, and we take traditional finance is about sort of top-down control. It's grown up that way. You have these sort of large centralized organizations where you can basically say you're responsible for forcing everyone to obey the rules. DeFi and decentralized protocols are much more like everyone driving on the roads and being trusted not to break the speed limit, and if they choose to, then they eventually get caught and arrested or whatever. And in that sort of vein, I think at the moment you go use Uniswap, it's going to be like, well, maybe you traded with someone who's a sanctioned person, and so maybe you broke some rule. Now, for us, crypto people, maybe we're willing to take that risk as individuals or whatever, but for getting it outside of there, you really need the ability to say, here are some tools that let me say, I'm KYC'd or whatever, and I would like to trade on DeFi in a way where I can prove later to a regulator that I've obeyed my local rules. You don't want to have those rules embedded in a blockchain. You'd have 190 countries' rules changing every week. It would be a nightmare. But you do need every user to be able to say, here's the rules I need to obey, and I need to prove to my auditor, accountant, whoever, that I've actually done something that's OK. And you look at Tornado Cash recently, all of that stuff, and they have a way for you as the user of Tornado Cash to unmask your transactions and go, here's who I traded with. And I think something like that will be essential to get this real world use that we're talking about.
That's very interesting. You have individual buy-in for regulatory rules, as opposed to the institution is the one who says we can't service you because of regulatory rules. That's pretty cool. Hart, you had a theory a bit about having instant settlement and stable collateral will change a lot of the needs for OTC agreements and ISDAs. Can you talk a little about how that can unlock some things in DeFi?
Well, yeah, some of the stuff Barney's talking about, let's imagine, again, in this weird DeFi world where we're doing DeFi things, if we actually have digital assets that we can see in real time and value in real time, we can use as real-time collateral to do real-time settlement and real-time margining, and you end up having an incredibly capital-efficient system. And there's some stuff, again, that goes back to why TradFi will have to adopt DeFi rules. In traditional finance, you remargin your derivative every day. You have a huge buffer of capital that you need to keep aside to guard against that derivative not being made whole. Our system can be made so much more efficient by these DeFi tools that can do continuous real-time margining. And I think that's the stuff that I'll let the other panels talk about, but that's the stuff that's so fucking cool, excuse my language, that lets us build really new, innovative systems that are fundamentally orders of magnitude better than what we otherwise can.
That's really massive. So we looked at the risk models to calculate margin, and we were concerned when we were designing Vega that not being able to know anything about your customer and not being able to go after them in the rule of, in a court if they did not pay their margin would be a problem. What we actually worked out was that by recalculating margin and marking to market every block, we get so much advantage in terms of how much less collateral is needed because of the safety of reducing the tau, reducing the time into which you can remargin, that you can have more leverage safely, at least from the perspective of the network, with real-time margining than you lose because you don't know anything about your customer and you can't go after them in court. So it's absolutely game-changing.
And all that is to say nothing of disintermediation, which is, I think, really one of the killer apps of DeFi. There's too many middlemen. There's too many middlemen, and there are too few key middlemen. And it's critical, I think. Like, finance is really bloated and it's rent-seeking, and I think that's one of the really exciting things about DeFi, the killer app there, in addition to what you guys just spoke about.
Awesome. So if we have a protocol that's derivative native, and a place to borrow money, and a protocol to lock in fixed rates, and an oracle to confirm off-chain data, we could have a pretty solid financial infrastructure. Look at that.
I think so.
Thanks very much, guys.
Thank you.
Thank you.